So I'm not going to make a drastic investment decisions based on relatively small differentials. On paper, if I were to make any investment decisions based on these, it looks like Disney is slightly cheaper than Netflix. Okay. Uh, so I would buy Disney and short Netflix. That means if market goes up, I hope that Disney is going to go up more than Netflix does. Or if the market goes down, I hope that Netflix is going to go down more than Disney does. You heard of things called hedge funds, right? That's what hedge funds do. This is a hedge position. It hedges the overall market risk. If tomorrow market dives 20%, as long as Disney dives less than Netflix do, you make money. That's what hedge funds do. They find trade ideas like these. But if I had a difference between 125 and zero point 0.5, that would be obvious trade. Don't make any decisions when they're that close. Uh, at the end of the lecture, I'm going to show you what I use for my own personal analysis. But there are two more ratios for PE type ratios to make sense. That E should be positive. Okay. If the company has lost money or is expected to lose money, the entire concept is flawed. So when earnings are not positive, people sometimes use price to book ratio, which is, we're going to call that PB, price divided by book value per share, or BPS. BPS is total equity per share. You can think of PB as market cap divided by book value of equity, which is simply assets minus liabilities. Okay. And the way to interpret that is to what extent market attaches a premium to the book value. Remember, book value is the accounting value for the firm right now. The first thing that's wrong with that concept is it's accounting value. That doesn't mean accounting is not a useful profession. It is for the purposes that it is useful for. But in terms of measuring, you should, if I'm going to think about the value of a firm right now, I should think about if I were to sell all of the assets of the firm right now, how much money would I get less the liabilities? The trouble is, not all of that is in the book value. I gave you guys the example of Steve Jobs, right? If you looked at the financial statements of Apple back in early teens, you would not have seen an item called Steve Jobs. Would anybody argue against the claim that Steve Jobs was a significant asset of Apple? No. Even the crazy guy Elon Musk is an asset to Tesla. Okay? Not to Twitter, but to Tesla. So to Twitter, he ended up being a liability. But either way, you don't see an item called Elon Musk. A lot of assets of the firms are undervalued in terms of book values. You know, especially things like buildings. You bought a building 10 years ago in Manhattan, and there's some depreciation as well. The book value of that building is significantly below what you could get in the market. But with that in mind, it just says how much premium market attaches to the book value. And that premium comes from what market thinks of future growth opportunities. When you buy shares in the company, you're buying into what they could do in the future. Okay? That's what market value is all about. When you buy NVIDIA, you're doing, okay, these guys are making a lot of money now, but I think they're going to make even more money in the future. That's what you're buying into. In the business of investment, what you have done for me lately means nothing. Okay? If you're doing this for friendship, you've been a great friend to me. You've been there whenever I needed you. Even if when I didn't need you, I could use that as a kind of anchor for valuation. That's never the case in business valuation. Yeah. What you've done for me over the last 12 months means nothing. What are you going to do for me in the future? Because right now I'm considering whether to buy your stock or if I own your stock, whether I should sell it or I should hold it. What you bought the stock doesn't matter. If you're trading, you should always say, my cost is yesterday's close because you had an opportunity to sell yesterday, you chose not to. That's one of the biggest errors traders make. They don't sell not to realize the losses. Then those losses deepen and deepen, and they get stuck. Remember, this is not a girlfriend or boyfriend you're talking about. You can dump them with no emotional baggage. Yes, realization of that loss is painful, but trust me, whether you realize it or not, you lost that money. All right, let's look at the PB for Netflix or for Disney, since I have that right here. Statistics 169. That means market attaches 69% premium to Disney's book value. For Netflix, that's 1361. So that's 1261% premium to the book value. That may be for a lot of different reasons. One of them is market is expecting a higher growth from Netflix in the future, or Netflix book value is a lot more undervalued compared to Disney's book value. You know, most of Netflix value comes from their algorithm, right? For Disney, their assets are a lot more tangible. You know, they have a lot of content that they have created or bought, and they have theme parks, they have buildings. Those are tangible assets. A lot of Netflix's assets are intangibles, and some of them, probably quite a bit of them, have zero value in the books. So, provided that's undervaluation of the book value is similar, you could use price to book as kind of a comparison. And even for price to book to make sense, the book value needs to be positive. There are companies where the book value is negative. Example, just check for yourself, American Airlines. Their book value of equity is negative. For a lot of charges that took during COVID years, it is negative. If BPS is negative, uh, you can maybe use price to sales. or PS ratio. It's basically uh, market cap divided by 12-month sales. Again, you could do that forward looking, backward looking. Same idea applies. As a general rule, I don't like that ratio. For that ratio to be useful as a comparison tool, the margins of the companies should be relatively similar. Okay? If you compare NVIDIA and Starbucks based on price to sale, NVIDIA has a gross margin of 75%. Starbucks has a gross margin of, if I don't misremember, about 30, 35 cents percent. So it's a apples to oranges comparison. One more thing that we want to do when we use earnings or when we compare companies based on their price earnings type stuff, leverage becomes important. For example, if I wanted to compare, uh, you know, FPE for Love, which is Southwest Airlines, don't ask me why the ticket is Love. I never flew in them, but I heard that it is not a very lovely airline. For Delta,